Welcome back. I'm about to show you something that should concern every person with a 401k invested in tech stocks, particularly Meta and the broader technology sector. But before we dive in, I want to emphasize that this analysis is based on historical patterns, SEC filings, and publicly available data, not financial advice. Always consult with a qualified financial advisor before making portfolio changes. Let's establish the core thesis. $30,000 is about to vanish from your 401k, and Meta's latest SEC filing just confirmed it. Meta Platforms announced a 10% workforce reduction in March 2023, cutting approximately 10,000 employees. This single announcement isn't just a personnel matter. It's a canary in the coal mine for what's coming next in their financial results. And if you're a tech worker holding $150,000 in RSU, company stock, or tech-heavy index funds like QQQ or VGT, here's exactly what that means. A 20% sector correction wipes out $30,000 in unrealized losses. But let's be specific about the numbers. According to historical data from the National Bureau of Economic Research, when large-cap tech companies announce layoffs exceeding 5% of their workforce, earnings misses follow within a 6 to 10-week window 78% of the time. This isn't coincidence. It's a structural indicator of operational dysfunction. The historical pattern. When layoffs signal earnings trouble, let's examine the pattern more carefully. In August 2022, Twitter announced a 50% workforce reduction. Within 8 weeks, in October 2022, the company reported a 40% decline in advertising revenue. In November 2022, Elon Musk announced that Twitter's cash flow had become negative, forcing immediate operational changes. Amazon provides another example. In November 2022, Andy Jassy announced the company would begin layoffs in earnest after hiring blitz during the pandemic. The cuts totaled 18,000 employees by January 2023. Amazon's Q4 2022 earnings, released in January 2023, showed a shocking 48% decline in operating income compared to Q4 2021. AWS growth slowed to 20% annually, down from 40% the previous year. Then, there's the 2008 financial crisis lesson, when Citigroup announced a 5,000-person layoff in November 2008, approximately 4% of workforce. Their Q4 earnings miss was catastrophic. They reported a $27.7 billion loss, the worst in company history at that time. Meta's 10% reduction, announced on March 23, 2023, cut 10,000 employees. CEO Mark Zuckerberg called it a year of efficiency, and the market initially rallied 5% on the announcement. But here's what the 10Q filing revealed 3 weeks later. They were slashing budgets, reducing hiring, and cutting contractor spending, all red flags for operational challenges discovered during the cost reduction analysis. According to McKinsey and Company's research on tech layoffs, when companies announce reductions this large without explicit revenue decline explanations, the probability of a subsequent earnings miss increases by 2x. Meta hadn't reported revenue declines yet. That's the concerning part. Decoding the SEC filing. The 380 basis point margin compression, now. Let's look at what Meta's SEC filing language actually revealed. The smoking gun that most retail investors completely missed. In their Q3 2023 10Q filing, Meta disclosed a margin compression of 380 basis points year over year. Let me break down what that means. Their operating margin fell from 39.1% in Q3 2022 to 0.9% in Q3 2023. That's not a minor fluctuation. That's a structural collapse. Meta's cost of revenue remained relatively stable at 16-17% of revenue, so the problem wasn't hardware costs or infrastructure spending spiraling. The issue was operating expenses. They disclosed that operating expenses increased 37% year over year, driven primarily by research and development spending and sales/marketing expenses. Here's the critical language from their 10K filing on page 73. We have made significant investments in technical infrastructure and personnel to support our artificial intelligence initiatives, reality labs, and metaverse development. These investments have generated negative returns to date and may continue to do so. Translate that SEC speak. Meta spent billions on R&D, particularly AI and metaverse initiatives, and these investments weren't generating revenue returns. The Reality Labs division alone lost $13.7 billion in 2022 and was on track to lose $12+ billion in 2023. That's the ultimate unproductive expense. But here's what the Q3 2023 margin compression revealed. Meta was finally acknowledging that their AI/metaverse bets had failed to produce commercial value. The path forward required dramatic cost cutting. This is precisely what preceded the March 2023 10% layoff announcement. The portfolio math. How $30,000 disappears. Let's make this concrete with actual numbers. Imagine you're a Google or Meta employee with a typical tech worker portfolio. $40,000 in company RSUs, or vested stock $60,000 in QQQ, Nasdaq 100 index fund $30,000 in VGT, Vanguard Information Technology ETF $20,000 in direct Meta stock. Total tech exposure $150,000. Historically, when megacap tech companies miss earnings guidance after announcing significant layoffs, the Nasdaq 100 QQQ declines 12-18%. In Meta's case specifically, the stock has declined 25-35% in the 8-week window following earnings misses. Let's model a modest 20% sector correction. QQQ declines 20%, $60,000, right arrow $48,000, $12, VGT declines 20%. $30, right arrow $24, $6, Meta stock declines 25%. $60, right arrow $45, $15, total loss. $33, this isn't hypothetical. Following Meta's Q4 2021 earnings miss on February 2, 2022, when they reported user growth slowdown, Meta stock declined 26% that week and 38% by March 1, 2022. The Nasdaq 100 declined 13% in that same window. Now, if your $150,000 tech portfolio is inside a 401k, you can't immediately rebalance to stock gains, meaning you're locked into these losses for tax-deferred realization. The opportunity cost is substantial. The pre-layoff signals in the 10K. What proved this wasn't sudden ? By minute 6 of this analysis, here's the critical evidence that Meta's operational problems existed long before the layoff announcement. They weren't sudden. Page 35 of Meta's 2022 10K contains this language. We have historically benefited from advertising delivered on Facebook and Instagram. Our ability to continue this success depends on our ability to engage users and advertisers in these platforms. However, we have experienced slower engagement growth and increased competition, particularly from TikTok. That's code for revenue deceleration risk. But here's what they said on the very next page. We anticipate that our expense growth will outpace revenue growth in 2023 as we continue to invest in AI, computing infrastructure, and Reality Labs development. Translate that. They knew in their 2022 10K filing, submitted in February 2023, that they were spending more than they were earning. This wasn't new. The layoffs weren't a reaction to unexpected circumstances. They were a reaction to admitting that 3 years of expense growth had exceeded revenue growth. Look at their actual numbers. 2020 revenue, $85. 9 billion employees, 58. 604-2021 revenue, $114. 6 billion employees, 86. 482, 47% employee growth. 2022 revenue, $114. 9 billion employees, 86. 482, 0 growth. 2023 revenue trajectory per guidance, $119-121 billion employees, 77. 233 post-layoff. You see the pattern. Revenue growth stalled between 2021 and 2022, only 0.3% growth, while they continued employing 86. 482 people. That's unsustainable. The 2023 10K filing would have revealed this brutal reality, which is why the layoffs occurred. The rebalancing move. Protecting your portfolio before the miss hits. So what's the single rebalancing move that might protect you before the guidance miss hits? Historical data suggests you have a 6-10 week window from the March 2023 layoff announcement until the earnings miss manifests in stock price. Here's the strategic approach, based on institutional portfolio managers' response patterns. First, reduce tech sector concentration from your typical allocation. If the S&P 500 has tilde 28% allocated to technology, and you're at 65% technology, common for tech workers, that's a 37 percentage point overweight. Reducing that to 40% puts you closer to institutional allocation without a panic sell. Specific execution. If you have $150,000 in tech exposure, reduce by $22,500, 15%. Deploy that capital into defensive sectors, healthcare, Roman 45, consumer staples, XLP, utilities, XLU. These sectors have historically declined only 6-8% during tech sector corrections. Second, if you hold company stock or RSUs approaching vesting, don't wait for the miss. RSU vesting is arbitrary timing. Don't let it determine your portfolio risk. Diversify immediately upon vesting rather than holding concentrated single stock positions. Third, consider a collar strategy if you hold significant Meta or tech stock. Buy out-of-the-money puts, downside protection, and finance them by selling covered calls, upside surrender. A 90-day collar at 5% below current price with calls at 10% above current price costs approximately 1-2%, but eliminates 70% plus of downside risk. Fourth, dollar cost average into defensive positions over 4-6 weeks rather than moving all at once. This removes timing risk. Counter-argument. Why this might not happen I need to address the bull case, because it exists. Meta's AI investments in large language models, Llama 1 and Llama 2, have generated legitimate competitive advantages. Their new Llama models are competing favorably with OpenAI's offerings, and they're monetizing through custom model licensing to enterprise customers. That's a genuine new revenue stream. Additionally, Meta's core advertising business may have stabilized. Q3 2023 advertising revenue grew 4% year over year, the first positive growth after 6 quarters of decline. If this trend continues, the cost cutting could be viewed as cyclically appropriate rather than panic-driven. There's also the argument that large tech layoffs are now normalized post-pandemic. Companies hired aggressively during 2020-2021, and 2023-2024 is simply correction. That's not necessarily a sign of operational distress, it's rebalancing. Conclusion. The bottom line for your 401k***, here's what we know with certainty. 1. Meta announced a 10% layoff following disclosure of 380 basis point margin compression. 2. Historical data suggests 6-10 week windows before earnings misses follow large tech layoffs. 3. A 20% tech sector correction eliminates approximately $30,000 from $150,000 tech-heavy portfolio. 4. Strategic rebalancing before guidance misses can protect 15-25% of potential losses. 5. The evidence was visible in their 10K filings. This wasn't sudden your move. Review your 401 K allocation this week.